Chapter 13, Part 3, Slide 34. Continuation with the preferred stock. A couple other terms, participating versus non-participating. Dividends may exceed a stated amount once common stockholders receive a dividend equal to the preferred stated rate. And then at that point, does the preferred stock continue sharing in those dividends? Yes, if you have a participating right. No, if you have a non-participating. Yes, I always argue for the participating rights when I negotiate for startup companies, but most companies do not give it. So these are terms that are very negotiable. So you think, why would a company issue preferred stock versus common stock? And there are some basic reasons. Number one, to raise capital without sacrificing control. If they don't have voting rights, you're not losing dilution of control. And so this can give a major shareholder, that edge for keeping the control. And it's also to boost the return earned by common stockholders through financial leverage. Because once a preferred stock has reached their dividend, and if they're non-participating, which most are not, then the other dividends that the company's doing well is going to go only to the common stockholders. And so that can be very effective if they're fast growing. And then it's to appeal to investors who believe that common stock is too risky, and so they want a higher preference for liquidation and dividends, and they're more conservative. And so they'll invest because it has that bond payment characteristic. So there are a variety of reasons to issue these stocks. It does get into a lot of legalese. I'm not going to try to make you a corporate securities attorney, but these are some of the more basic things that you are going to see out there, though. Treasury stock. We're not done with stock yet. So, treasury stock represents shares of a company's own stock that has been acquired. So what it has said is that it has issued stock and then maybe rebought it back and so forth. It can use its stock to buy other companies. It can reissue to employees or to support the market price. So there's a variety of reasons why companies go out and buy their stock when it's available. Case in point, if the board of directors feel that the stock is very undervalued by the marketplace, they might go aggressively start buying their own stock because they think they can make more money also. So it's not uncommon for companies to have their own stock on their balance sheet, and they can trade it just like any other investor. So purchasing treasury stock, well, you're just going to have to create another T account, treasury stock common, and then cash. So this is stock that's already been issued. The thing about issuing stock is that it usually requires a lot of SEC regulation. They usually issue a big block at one time, and they don't just issue in small drabs. So now they're buying it back for whatever reason. And so it'll also show as a reduction in the total stockholders on the balance sheet. You will actually deduct it, but they have the right to sell this back without filing again to the SEC, and that's why one of the advantages of doing this. So selling it, well, you're getting cash, and you just go ahead and it's a straight journal entry here, and you might just journal this component, the explanation, and so forth. Selling stock above. So here, they bought stock for $2,000, but they're selling it for $4,000. So they're making money. So they have paid in capital treasury stock in excess here. So again, selling stock below, you're going to take a hit of that $1,000. So let's get into the stockholders' equity section of a corporation's balance sheet. And there's two parts. And that is paid in capital, which is what we've been doing with the par value and excess of par value. And then retained earnings is earned capital. So this paid in is what's contributed by investors. This is what the company has earned and kept in. And now they might have made a lot more than this amount, but paid a lot in dividends. But this is what the company has kept in its earnings throughout its history since whenever it started. So the statement of retained earnings. Retained earnings is the total cumulative amount of reported net income less any net losses and any dividends declared since the company started. For instance, like Ford, this could go back over 100 years. So this is a huge component of the balance sheet for many times. There are restrictions on retained earnings. Most states restrict the amount of treasury stock to purchases. I'm not going to test this. I think this is way too much detail. But there can also be contractual restrictions. So this is legal by the state, but this is contractual that might be investors or creditors might put on to and restrict the management or the board of directors from doing things. And it's not unusual that loan agreements can restrict dividend payments until the loan's been paid off. So this is not an uncommon agreement. I use this all the time when I was a corporate investment banker with Bank of America. We will restrict it. We want to get paid first before the shareholders. So we'll put those kind of restrictions in. So you have to have appropriate retained earnings. Again, corporations, directors can voluntarily limit dividends because of special needs for cash. Like they might be trying to hoard cash because maybe they want to grow and buy a building or maybe some other investments. So they don't have to declare to pay dividends. And so here they've decided that they're going to appropriate or keep these retained earnings in. And so they're taking this 450 saying, no, we can't pay this flat out, but we can pay up to this amount. So it's possible that they could state that. Prior period adjustments are corrections of material errors in past year's financial statement that as a result in change in the beginning of balance retained earnings. Yes, believe it or not, sometimes not only students but other professional accountants make mistakes. It's human. And so you have to, but when found, you've got to correct it. And sometimes if that was in a much earlier period, you're going to have to adjust it this period and note it on the financial statement and so forth. So it could be an increase or a decrease depending if it was a profit or loss. So the statement of stockholders' equity, yeah, they're going to show how many shares are out, common stock, and excess of par, retained earnings, and this can be very complex if there's different classes of stock and different series of different classes of stock. So this can get quite complex. Stock options. You probably have heard this term. This is how a lot of times managers get very, very wealthy, as well as some other investors. And an option is a legal right to purchase common stock at a fixed price over a specific period of time. And as the stock price rises above its fixed option price, the value of that option will increase. And it can also decrease if the stock value goes down, so they'll think this is a one-way street. And options are used a lot in financing, sometimes to entice investors to come in because maybe the company's hurting. It's also to award options to employees that as the company grows, they are now benefited. And so it is given to key employees. It takes it's a way of locking employees to stay with the company and so forth. And also to increase their level of performance in helping the company grow. That's the major component. Let's get into a couple ratios and then we're done with this chapter here. This is the big one, also known as EPS, earnings per share. This is tracked by the financial industry in depth, so get used to it. And so it's one of the most widely used in the financial circles. And basically what it is basic earnings per share is the net income of the company after the revenue minus all the expenses and taxes, minus the preferred dividends. Remember, these guys have preferential dividends, so you have to pay them first. And what they're really saying is this earnings per share is to the common shareholder. We're trying to measure the common shares. And when you see weighted average, again, whenever you see average, take some beginning period, add in some later period, and usually you divide by 2 is one way to do that. PE ratio, price earnings ratio. Another huge one that's tracked by the stock market. This ratio talks about how well the company is doing against each share of stock. So you got a market value per share. Notice it doesn't say par value. It says market value. Where do you find that? You don't get this in the financial statements. You have to go outside of your financial and accounting information. You might have to look this up in the Wall Street Journal or some other current periodical that's tracking the stocks. And then you take the earnings per share. And so you divide that out. And this is how we're tracking if the company's going up. And this is also known as the PE multiple. And it's very much tied to the financial industry. Dividend yield. How much dividends is each share of stock earning for that year? And it's sort of like return on investment or yield on a bond. It has the same sort of concept. So you see dividend yield could be like a yield of a bond payment and so forth. So that is also tracked by dividend investors. Book value per common share. Notice it says book value, not market value. Book value, another term for that, is accounting value. What do we show on our books, our accounting books, not what the stock is trading for in the marketplace. So that, again, this is a whole different number. This number we will find in the equity statement of the balance sheet. You don't have to go outside. So it's, again, stockholders' equity, i.e. the common shares. You take away the preferred stock contributed capital, and then the number of shares outstanding to get its book value per common share. Has no relationship to market value. Book value preferred, same concept, only at this time you're taking it to a preferred share value. We're almost done with this chapter, bear with me. Some other company legal entities that are related to corporations. There's an S Corp, and what an S Corp is, it's a subchapter of a C Corp, which is the common corporation. And again, an S Corp is a special company that has the ability to be taxed like a partnership, but has some legal protections of that as a company. There's a lot of restrictions. Typically, you can't have any more than either 50 or 100 shareholders, and there can only be one class of stock. So it's a very specialized company. A lot of families in a family-run business might use an S Corp. Then there's LLC, limited liability company, common to like a limited partnership. Okay, then there are professional corporations that are designated for like doctors and dentists. So these, again, is a special class of company legal forms. That's it for chapter 13. I know it was a long chapter, but good luck with it. And do spend some time in learning this terminology, because it is very easy to get this confused.